Wealth interview series. Today we have Gerald Stack. He's the lead portfolio manager for the Magellan Infrastructure Fund. He's been with Magellan since 2006, I believe, and you're also the head of the Magellan Investment Committee, or the chair. Is that right?
That's right, Tim.
I bet that's like herding cats, a bit tough, jostling with Hamish a bit.
Well, Hamish is a big cat and he's very mobile, but there are a few other cats that you have to deal with as well.
Yeah, I bet.
It can be tricky.
Gerald, look, we're seeing a lot of optimism in the markets now. It seems like a vaccine may be coming soon. We have Biden as president now. Markets are very optimistic. Is now the time to be putting money into infrastructure?
Tim, look, I certainly don't think it's a bad time, but I think I would have been saying that pretty much through most of the year. What we know about infrastructure is that ultimately, infrastructure as we define it does two things. They deliver essential services, and for us, not only do they deliver essential services, but we've also screened out anything which faces external variables that mean, albeit they provide an essential service, they don't face reliable earnings or cash flow. So essential service essentially means that they're involved in either the provision of energy, the provision of water, or the provision of transport, and that we know that those services are essential to the way that communities function. And as a result, the demand for those services are very reliable over time. And the key is over the long term, not just over the short term. We've certainly found this year that the demand for those services in the short term can be interrupted, but we're very confident over the long run about the nature of those services. And as a consequence, while there may be some short-term volatility, I think we should be very confident about the nature of demand for those services. And then because we've screened out things like commodity price and competition, what we're left with is not only very reliable demand, but very reliable earnings and cash flows. So for example, in the utility space, utilities typically operate across multiple sectors. They generate energy, they then send that energy down high voltage transmission or distribution lines that come into your house or place of business, and then finally someone sells you electricity. So 3 or 4 very different parts to the industry. Now in that first part, generation, the price of energy, if you're a merchant supplier, that is if you're working in competitive markets, the price of energy in Australia in calendar 2019 fluctuated somewhere between $14,000 a megawatt hour at the height, in terms of the maximum price, and negative $500 at the minimum price. The average price was about $90 an hour. Per megawatt hour. So anywhere between $90 is the average, you're actually anywhere between $14,000 and negative $500. So you've got this very variable price, and therefore, notwithstanding that the demand may be reliable in terms of volumes, you've got very variable and volatile revenue and earnings. So we don't want to be in generation. Transmission and distribution, they're natural monopolies providing an essential service, and as a result, they're regulated. And most investors would see regulation as a problem, a threat, a risk. We see regulation as our friend. Regulation to us means that when times are tough, you can earn very reliable, predictable returns over time because the regulator allows you to put up your price, to use your monopoly power, such that you're able to achieve those very reliable earnings and cash flows over time. So we don't want to be in generation. We do want to be in transmission and distribution. The final piece is retailing, and most of your clients, I imagine, will have probably had a call from someone on a Wednesday evening at about 7:30 p.m. offering them very kindly to facilitate their switch from their existing energy supplier to a new one, probably for about $30. And that is competition in action. You know, they're forcing down the price of the retail price of energy. So competition, a wonderful thing for consumers, but not such a wonderful thing for the companies, for people participating in the marketplace. And in particular, if you're an infrastructure company with a lot of capital invested in the business. So we don't want to be in retail. We don't want to be in generation. We do want to be in transmission and distribution. So when we come to define our world, we start with around about probably 180 to 200 companies that sit in the utilities bucket. And out of that, and when I say sit in the utilities bucket, they're providing an essential service. But of that, let's call it 180. Of those 180 companies, there's about 100 of them who earn more than 25% of their earnings out of either generation or retail. And that's the test for us. We want no more than 25% out of generation retail, or alternatively, we want a minimum of 75% from transmission and distribution, from the poles and wires. So as a result, we kick out those 100 companies. We go from 180 potential utilities that we could invest in to around about 80 that we can invest in, and they're the 80 that we focus on. And that's really what we're doing across our space. We're focusing on those things that we're very comfortable and confident on over the long term, that they'll generate reliable, predictable earnings. And then hopefully we're constructing a portfolio that will collectively put that together in a way that gives us those reliable earnings with a bit of upside along the way. So we certainly know today that the bulk of these businesses continue to perform okay. There are particular segments that haven't done particularly well: airports, toll roads. We can come back and talk about those a little bit more. But as they've been priced for that in the meantime. And if you look at, even notwithstanding the fact that this year has not been a great year for infrastructure, if you look over the last 5 years at the returns from the fund, or indeed since inception, you'll see that the returns have been very much in line with thesis. And our thesis here is inflation plus 5%. So if we say inflation's ballpark 2%, then we're talking about total returns of 7%. And we should be confident, we think, about delivering those sorts of returns over time. If we look backwards, we've certainly delivered that. And as we look forwards, we see no real reason why we won't deliver that again. These assets are generally not particularly sexy. And this is not get-rich-quick sort of territory. But it is the sort of territory where you can be pretty confident that you're going to grow your wealth over time. There's a high degree of confidence that you'll grow your wealth, much at perhaps a more smaller clip, a lower rate, but a high degree of confidence that you'll get there, because the services are essential and there's none of these external variables affecting where you're at. So long answer to a very short question. But yeah, we think it's absolutely a fair time, a good time to invest in infrastructure. And we've continued to believe that through the course of the year.
So CPI plus 5% long-term average, but right now, do you see more upside in terms of opportunities for infrastructure?
Yeah, so then I think you're going to start thinking about the different segments. So our universe is essentially your regulated utilities and infrastructure, or transport infrastructure, transport of people, goods and data. Utilities represent about 60% of our universe and infrastructure 40%. Utilities this year, what we've found is that generally, we've gone through third quarter reporting, so we know they've reported for the first 9 months of the year. And at the start of the year, the utilities all essentially tell us or predict. They give guidance. They give a prediction of roughly where their earnings will be for the year. And having run 9 months through the year, notwithstanding the effects of the pandemic and what's gone on, those utilities have essentially all reiterated their earnings guidance for the year. So in other words, their earnings have been unaffected by COVID-19 and the quarantining. That's not to say that their operations weren't affected. They've typically seen much, given that people are quarantining at home, they've seen much lower levels of demand from what we talk about as commercial and industrial sectors, businesses and factories, if you like, offices and factories. So much lower levels of demand there, but much higher levels of demand for residential. And we've also said they've had higher elevated bad debts through the period. There's some businesses that have gone out of business and they're not going to be able to pay their bills. So there's some things that have gone on, but because they've been able to go and deal with some of these issues with the regulator, and they've been able to mix, they're getting higher margin on residential versus the lower margin commercial industrial, and they've been able to reduce some costs, their earnings are unaffected for the year. And this is very much true to thesis. So we've seen that through the year, earnings unaffected. In addition to which, we've seen interest rates, become even more benign. At the start of the year, if you'd asked me about interest rates, I would have said that our base case, our most probable case, is that interest rates will be lower for longer. To now, I think if you asked about our base case, we would say it's going to be lower for a lot longer. And while interest rates are not the only thing that matter when it comes to utility valuations, clearly the businesses matter. Low interest rates are very supportive for infrastructure generally and utilities particularly. So we've got fundamentals unaffected, interest rates very supportive for value, but notwithstanding that, to the end of October, utility values are down on our analysis about 5% on average. So utility values down, they've been hurt through the period. As I said, somewhat surprisingly, given the fundamentals are unaffected and valuation looks supportive. So when we look at that 60% of our universe, it looks more attractive than what we would normally expect. So, as I said, the normal expectation that we would talk to is sort of inflation plus 5, let's call that 7, At the moment, we're probably talking maybe another couple of percent over the next 5 years out of that section of our portfolio. So it's not going to turn our world upside down, but we think we're finding it quite attractive, and arguably more attractive relative to the rest of our universe than we've seen it for some time on our analysis. So that's 60% of our universe. The other 40% of our universe is infrastructure, and infrastructure could be airports, could be toll roads, could be rail, could be communications infrastructure. So if I deal with airports first, airports have clearly had a terrible year. The worst month was April. Passengers were down around about 95% in April. International passengers were down 98.5%. Domestic was down about 87%. These are IATA numbers, the Global Airline Alliance. So very significant down. As I said, let's call that down about 95%, give or take. In the most recent month that IATA has reported for is September. And in September, global aviation passengers versus September 2019 were down around about 72.5%. Again, IATA numbers. So we've gone from down 95 to down 72. Now, down 72 is still pretty ugly. Let's not beat around the bush, but it is a progressive improvement. We are starting to see green shoots, and we can see that passengers will come back. What's stopping passengers at the moment is essentially quarantining. In certain jurisdictions, we've seen passengers come back almost to 2019 levels, and indeed in China, the most recent numbers out of China is that domestic passengers are above where they were at in 2019. So we can be confident that people will fly again, but it's going to take some time. If we think about the reasons why people fly, there's sort of essentially three broad categories of airline passenger. Leisure, people travelling for holidays, visiting friends and relatives, what we talk about as VFR, so going to see your family and friends. And then the third piece is business. Now, leisure and visiting friends and relatives, we expect to come back pretty quickly. And indeed, all the signs, all the surveys of people would suggest that the intention to travel for either a holiday or VFR, visiting friends and relatives, it remains pretty high, pretty consistent with where it was pre-pandemic. Business, though, a little bit more circumspect. Now, globally, business travel accounts for about 25% of the people who travel, but probably higher margin seats, a little bit more business class and the like for the airlines. For the airports, it doesn't matter so much. Now, that business travel we would expect will take a long time to get back to 2019 numbers. And arguably, there's a section of that business travel that will never come back. And that's not to mean that it won't get to 2019 numbers. It'll just take longer to get there. And why? Because businesses are doing a lot more of these calls, whereas in the past we would typically go and visit our clients, our practices around the world, both in Australia and around the world. At the moment, we're doing calls, not unlike this, Zoom and Microsoft Teams, on a pretty regular basis. And so businesses we would expect are probably becoming much more used to this concept. And given that there'll be a number of businesses under cost pressure, we expect there'll be much lower levels of people flying for business reasons. So IATA, the Global Aviation Alliance, their forecast is that that globally passenger numbers will get back to 2019 levels in somewhere around the 2023-2024 mark. The airports that we've spoken to are generally a little bit more sanguine. They point to sort of 2024 out to sort of 2028. And the mix of passengers in each of the airports is different. So depending upon the mix, you're going to get it. It's going to come back at slightly different rates. And certainly, if business is a big part of an airport's passenger mix, then it'll take a little bit longer. Will it come back? Yes, but there's certainly some uncertainty around that. Now, if IATA is right and passengers come back in 2023, 24, then airports to us today look pretty cheap. However, there remains a wide degree of uncertainty. Clearly, we've had some very good news around the development of vaccines, but we still have some safety hurdles to get over, and then to work out how those vaccines are going to be deployed in a safe and efficient manner around the world. So there are some things that still have to happen here. I guess we're facing much less uncertainty than what we were pre the announcement of the successful development of the vaccines, the successful efficacy levels of the vaccines. But if on our analysis, if we can get back to 2019 numbers by 2023-24, then, as I say, airports would be a pretty strong investment opportunity. Now, we're not at the moment allocating additional capital, or we haven't been allocating to this point additional capital to airports because there's still such a wide degree of uncertainty. But that's something that we'll be looking at long and hard over the upcoming weeks and months. So that's airports. Toll roads. There's sort of two types of toll roads: urban and interurban. Interurban roads connect multiple towns and cities. So, for example, Atlantia owns 70% of the motorway system in Italy. It also owns interurban roads in Spain and France, and also in Chile and Brazil. In its interurban roads in Europe, Atlantia suffered traffic declines of about 85% in the worst week in April. Then traffic levels progressively improved, such that in the summer months, traffic was actually up in France on 2019 levels, and in Italy it was down about 10%, Spain down about 10 to 15%, something of that order. Subsequently, we've had the second wave in Europe. Traffic levels have declined again. We've seen a similar thing with urban roads. So if I think about transurban, the traffic levels in Sydney, Brisbane and Melbourne were all down around about 50% in the first peak of the pandemic. Traffic levels in Brisbane and Sydney have then recovered somewhat to be down in the most recent reporting, which was sort of September. Traffic was down about sort of 10%, 10 to 15% in Sydney and Brisbane. But in Melbourne, it had significantly worsened with the second wave and was down something like 65%. What we've seen in both interurban roads and urban roads is that the traffic, when we stop the quarantining and the health outcomes improve, that people come back to roads in pretty quick order. And we'd be reasonably optimistic that we'll get back to 2019 traffic levels by something in the next, say, 2 or so years, sort of the medium term. And the reason is pretty simple. If you think about traffic, ultimately it's a function of the population, the total population in a catchment area, and it's a function, firstly, of the population, and secondly, of the total level of economic development in the catchment area, the number of businesses in that area. So while as a result of the pandemic, economic growth may go backwards for a period, or at least be slow, and economic and population growth may also slow, the total stock of population, the total stock of economic development, we don't think will change too much. And as a result, traffic will come back pretty quickly. And there may well be something of a spur to traffic in the short term, given that people seem to be uncomfortable or unsure, sort of risk averse, if you like, about travelling on public transport. So airports, very poor year. We can see that there's a longer term that they'll return to normal. Toll roads, a pretty terrible year as well. Not as bad as airports, but pretty terrible, but recovering over probably the medium term. Rail, which is freight rail in the US, freight rail volumes at the height of the pandemic were down about 30%. They've now recovered to be broadly in line with 2019 volumes. So a reasonably quick recovery there. And then we have communications infrastructure assets. I think we've all found or come to understand how important high quality broadband is around the world. And given the move to 5G over the next little while, we continue to believe and expect that the amount of data, the volume of data going through these communication networks is only going to grow at a very solid rate. So the volume of data through mobile communication networks has grown at something like 40 to 50% per annum over around about the last decade. The most recent forecast we've seen for this come out of a tower company known as American Tower, where they're forecasting that data levels will grow at something like 30% per annum over the next 5 years. So continued significant growth in data. As I said, people have come to understand how important high quality broadband and mobile telephony is. And as a consequence, there's the outlook for investment in communications infrastructure is extremely strong, and therefore communications infrastructure companies are doing very, very well. And their share prices have reflected that. Over the 10 months ended 31 October, they're up about 28%. So airports are down about 35%. Toll roads are down about 17, 18% to the end of October. Communications assets up about 28% on the other side of that. Similarly, rail is up over that period. So you're getting slightly different things from different sectors, but there's certainly, there are places to invest where we think we can find attractive returns, And we've just got to marry the fundamental story with the valuation story. For us at the moment, utilities look particularly attractive relative to where they were. Airports look potentially attractive, but a wide range of outcomes. So we're not quite going there yet. Toll roads are cheap on historical measures. And, as I said, we're optimistic about the recovery. So we're certainly looking at deploying more capital there. Rail, again, has returned to normal pretty quickly. We think there are some opportunities there. And then communications infrastructure assets, fundamentally highly attractive story, but arguably sort of priced for it. So we look very closely at the communications infrastructure assets, but probably not huge amounts of capital additional incremental capital in the portfolio going to that space.
So essentially, the strong thematics of urbanisation, low interest rates are going to stay for a long time, at least 3 years. The recovery will be uneven, but it's just a waiting game, essentially. A few years, 3 to 5 years, everything should get back on track.
Yeah, look, I think for rail, for communications, for utilities, the outlook remains positive. We've seen little or nothing upset the investment story there. In airports and toll roads, which are fundamentally about the movement of people, goods as well, but particularly people, then the quarantining of people has meant that there's been a hiatus, if you like. There's been a little bit of a hiccup for them and some share price volatility. But the outlook from where we sit looks okay. We need to be cautious around airports, we think, but we certainly can see that in toll roads there's a very investable opportunity there.
Sure. Look, it's been a very long time since we've had a pandemic, before our lifetime, certainly. I know even when the news was coming out of China, the market seemed to be very bullish. They kept riding up. I know with hindsight, but were there any lessons to be learnt coming back and reflecting what's been happening last year?
Well, I think the first one is probably on the pandemic itself. I think a number of investors had acknowledged prior to the pandemic that a pandemic was certainly possible. What the pandemic shows is that risks that are possible can happen. Don't discount them too much. They're real. And therefore, from where we sit, being exposed to a wide range of high quality assets within an infrastructure portfolio, but more broadly within a portfolio, we think makes a lot of sense. These are the benefits of diversification. So I think that's the first thing. Then in terms of the market reaction to the pandemic, we've generally found the market reaction to be pretty logical and sensible. The market, sold off aggressively. It did so because there was a huge amount of uncertainty back in March and April, and it responded to that in our view in a manner that we would have considered sensible. And then as that uncertainty has diminished, so markets have recovered. And I don't mean all markets, but I mean those markets that are particularly affected by these sorts of issues. Markets to us haven't been, from what we've seen, we wouldn't say that they've overreacted at any single point in time. We feel that they've embodied the right level of information. It's been no easier to find opportunities in the depths of the downturn as it was, a week before the pandemic hit. I guess the message there is know what you're investing in, know what the long-term investment fundamentals are, and if share price deviates from that, then absolutely take advantage of those opportunities.
So, Gerald, it looks like that the recovery is going to be very uneven. Can you tell us a bit about some of the major changes to the portfolio positioning you've made in order to take advantage of this situation?
So prior to the pandemic, so let's go back a step, sorry. Our universe is 60% utilities, 40% infrastructure. Prior to the pandemic, we were positioned as roughly 55% infrastructure and about 41% utilities. 4% cash. So 55 infra, 41 utilities, 42 maybe, something of that order, 3 to 4 cash. And of the 55% infrastructure, approximately 19% was in airports. There were 6 different airport investments in the portfolio. So no single airport was a significant portion of the portfolio, but collectively they were a material weight in the portfolio. Today, what we did really in the pandemic reasonably early on was to sell down that airport exposure and to become more defensive. So we sold down from 19% down to about 6% in airports, and we went from 3 to 4% cash to 15% cash. So then where do we sit today? Today we're about 48% utilities, about 42% infrastructure, and about 10% cash. In fact, about 9% cash today. So we've basically left our weighting to infrastructure roughly where it was when we first found out about the pandemic, and we've reallocated additional capital out of cash into utilities over time. We're looking to progressively allocate back into the market, into those things where we can see very limited downside, but some degree of upside. And so where are those opportunities for us at the moment? Utilities, as I've touched on, to some degree, toll roads, and then at the margin, rail and communications assets. So our portfolio went from, and our traditional view had been that we wanted to be overweight infrastructure relative to utilities in terms of where our universe was. So we had 55% in infrastructure versus 40% of the universe, 41, 42 in utilities versus 60% of the universe. We're now more heavily weighted to utilities than we are to infrastructure, and our marginal capital at the moment is going towards utilities rather than infrastructure, by and large. So we're more defensive, but progressively allocating that cash that we originally went in selling down airports back into the portfolio.
Okay, so what indicators would you want to see to deploy more cash?
Most broadly, I guess there are two key things. One is we want to be confident in the health outcomes. Certainly the level of confidence we can have in the health outcomes has rapidly improved in the last couple of weeks. And so, there's certainly much less uncertainty in that area. So I wouldn't say we've completely ticked that box, but we're certainly heading in that direction. The second one is we want to get some confidence about the nature of the recovery. And then finally, what we want to be able to do is identify investments that we think offer attractive risk-adjusted returns. Let's not forget that the companies themselves have to offer an attractive risk-adjusted return. So, we're in the process of ticking, I guess, all of those boxes. For airports, we particularly want to have some confidence about the health outcomes, or about the development of the vaccine and so on. For other sectors such as utilities, toll roads, rail, communications, the health outcomes are somewhat less important. It's not to say they're not important at all, but they're less important than they are in aviation, because without a successful development of a vaccine, then we don't expect that governments will reopen the borders to global aviation in the way that we would want that to happen, and the way that airports need it to happen if they're to represent, to make full use of their capital base. So they're the things that we're looking for. We can certainly identify some things that look attractive to us at the moment. I've touched on utilities and I've touched on toll roads. We're starting to see, we're doing a lot of work around what's going on in individual economies and the nature and pace of which we expect economies to recover. And then health outcomes is the third piece.
Yeah, that makes perfect sense. One of the things that our investors love about infrastructure is that it pays a very nice, consistent yield.
Yep.
Given the effects of COVID, are you expecting the yield to go up or down or stay the same?
We essentially don't expect too much change here. So the yield pre-COVID was around about 3.5%. So if we say a total return of 7, we were getting income of about 3.5, and we're getting capital growth of about 3.5%. We would expect to see very similar yield out of maybe edging up a little bit over the next 6 to 12 months, subject to obviously to what capital prices do. If capital prices rise and the yield goes down, capital growth goes up. So why do I say that? Well, utilities are offering you a slightly elevated yield compared to where they were previously. As I said, the share prices on average are down about 5%. Their earnings have actually grown on average, probably around about 5%. So, and if assuming their dividend payout ratio remains the same, basically their yield's grown by about 10%. So if they were yielding 3.5 before, they're probably yielding something like 3.7, 3.8% on average today. So that's the utility piece. As I said, we've got a higher weighting to utilities than we did previously. Airports are clearly yielding at or close to zero. The bulk of airport companies have put their dividends on suspension. They're preserving capital, and they won't start paying dividends again until their businesses come back to normal. Now, it's a much smaller piece of our portfolio, 6 to 7% today, but they're paying limited, if any, dividends. Toll road companies are generally paying dividends, but their dividends have been reduced to reflect operating cash flows, which are a very sensible policy. We absolutely agree with. And we would prefer they didn't pay dividends out of capital. We want them paying it out of operating cash flow. But clearly this year, operating cash flows will be down, and it will take a year or two before operating cash flows return to 2019 levels. So as a result, the dividends that we're getting out of those companies are going to be a little bit lower. The share prices are also lower, so it may well be that the yield doesn't change too much on those companies, but it's still early to work out exactly how that's going to play. And then communications assets and rail, we're continuing to pay dividends in line with historical experience, or all indications are that they continue to pay dividends in line with historical experience. So really, we've got utilities paying slightly elevated, toll roads probably paying slightly down, and airports paying significantly down. Net in the wash, our view would be that it's not going to change too much.
I believe you guys, the Magellan Infrastructure Fund targets a 4% yield. That's one of the things our investors really like, that nice, consistent dividend.
So we're committed to paying 4%. We'll continue to pay 4%. It means some of the dividend may come out of capital in any given year. And similarly, if the income's greater than 4%, some of that income will go into capital. But investors going forward will receive a 4% dividend.
Yeah, that nice consistency. Excellent. Look, thank you very much for your time. I mean, here at Catapult, one of the things we like about infrastructure is that it does have a very strong long-term thematic of population growth. I mean, that story is almost unstoppable. So thank you very much for your time, Gerald, and thank you guys for joining us.